Hey there, Jorge Montoya here with the Montoya Mortgage Team. And today we're going to compare markets. Many people believe that maybe we're reliving 2008. So today we're going to address, will this be 2008 all over again for the housing market? So let's take a look at a couple different things that happened in the 2008 market versus what's going on today. So let's get it started. So number one, 2008, too much inventory. There was a lot of homes for sale and not enough people buying these homes. Number two, CISA, Nina, and Ninja, no ability to repay. So let me break this down for you. Stated income loans, no income, no asset verification loans, and literally no verification of nothing loans, which is kind of ludicrous. And that was something that is a really big factor because people were getting home loan financing without the requirements of verifying credit and verifying income and verifying assets to make sure that these consumers have the ability to repay. That was going on quite a bit in 2008 with some of these exotic loan products. You also had pay option ARMs. ARMs stands for adjustable rate mortgages. And with these pay option ARMs, they would give you sometimes 3 to 4 different options. So to give you an example, one option could be the real payment, principal plus interest. But during that time, very few people were paying that option. They had a secondary option, which was the interest only option, which means you get a reduction to your monthly payment. Let's say if the real payment was $3,000, with the interest only option, you may only be required to pay, let's say, $2,200, right? So that gives you a much cheaper payment. But then there was a third option called the negatively amortized pay option. And that's when you're not even paying principal, you're not even paying interest, you're paying a really reduced payment, and then the difference is being tacked onto the mortgage every single month, which is pretty nuts if you think about that. Now, the problem with this type of financing is that interest rates were doubling in like 90 days. So maybe you got in with a teaser rate of like 2% and then the market changed and now your interest rate was 9%. And that creates a lot of heartache, a lot of pain, and of course naturally payments to go up, but this was going on in 2008. Also, the mentality was different. There was the ATM mentality that stripped homeowners' equity. People just cashing out left and right, trying to over leverage their homes. That was happening a lot. And then also one big problem on the mortgage side was, better said on the servicing side, is poor servicer loss mitigation options. You see, we weren't prepared as an industry to deal with defaulting loans and a huge scale that we saw back then. So there wasn't a lot of solutions to some of these homeowners that started having their payments go out of control and falling behind on their monthly mortgage payments months at a time. So the response rate was very slow, which led to a lot of foreclosures. There was also the flipper mentality, right? I think that mentality, it like goes away and then it comes back as markets change, but people were just in real estate just to make money. Let's buy real estate, let's sell real estate, make as much money as we possibly can. And that was the mentality that was going on in 2008. So we talked about 2008 market. Now let's talk about today. What are we seeing? So again, we are still seeing too little inventory, 4 million units short of the market needs. So I can see some similarities there, right? We still don't have enough homes. However, there are some big differences. So when it comes to underwriting, over the last decade, financing has been full documentation. And what we mean by that is that we're verifying incomes, we're verifying assets, we are doing our job, which is something that our industry got a little too loose when it came to lending. And that's when all the exotic loans came out that verified literally nothing. But now we are documenting everything as an industry, which is good. That tends to lead to more responsible financing. And the reason that leads to more responsible financing is because now we are demonstrating there's a clear ability to repay. You can either afford this mortgage and therefore it is extended to you because your income was verified, your credit, your debt to income ratios have been analyzed. So that's a really big differentiator. People obtaining mortgages over the last decade actually had to qualify for them, which is a really good thing. Now, one big differentiator is fixed rates and fixed period ARMs. So one of the things that led to massive heartache was having your payment just all of a sudden rise $200, $300, $1,000 a month just because it was a market shift. And over the last decade, the majority of mortgages are fixed. 30, 20, 15, 10-year fixed loans, which is a big deal because you don't face payment shock. If you got into your home paying $2,000 a month, you're not going to $4,000 a month overnight because you got a fixed rate loan, which is really, really important. And at the moment right now, when it comes to lending and pulling cash out of the home, there's actually less cash out refinance programs. So homeowners are retaining their equity within their home. And if you're trying to pull equity out, it's a little bit more difficult to do so versus back in 2008, where you could pull as much as you wanted almost from your home. So that's changed quite a bit. Now, one thing that has dramatically changed is forbearance. Now, this is an area where as an industry, we were too slow to act. I mentioned a few moments ago that we weren't prepared for the massive amounts of people not performing on their mortgages, and there weren't really solutions to help them either catch up or modify their home loans or move fast enough in order to keep them in their homes. But nowadays, forbearance is available for loss of income, loss of your job. And for example, some people, when approved for the forbearance, they may have the ability to not make any payments for 6 to 18 months if your job was lost, which is a big, big help. And even further, for people that have FHA loans, once you go through that 6 to 18 month period worth of no payments, naturally that balance is accruing. But then you could apply for something further called an FHA partial HUD claim, which now takes that difference and just creates a secondary note that you pay back to the bank whenever you sell or refinance your home. So that is a big game changer, because options like forbearance allows us to keep homeowners in their homes because life happens, right? Life happens. Another thing that's changed is also the mentality. Right now, the mentality for homeownership is really a long-term investment outlook. We're buying homes because we want to live in them, we want a safe space, and now more than ever after living through COVID, a home has taken a whole different value. It's a safe place that becomes invaluable to families. So the mindset has changed. And then of course, you want a safe, happy, comfortable home and work location, because work from home options are now a thing that didn't used to be as seen as often pre-COVID. So there you have it. You've got some similarities, but in my opinion, a much different market today versus 2008. And one of the biggest reasons, in my opinion, is because of financing. You don't have payment shock. You don't have millions of homeowners that are about to see their home loan payments rise, which is something that really brought our financial system to its knees. And then the second big thing that I'll reiterate is the ability to repay. Homeowners today had to prove they had the ability to repay, and therefore it was a more responsible lending. So there you have it. If you have any questions, we're here to serve you.